September 15th, 2008, 1:45 at Lehman Brothers headquarters, Times Square, Manhattan. A glass tower glowing above an exhausted city. Inside, on the 31st floor, CEO Dick Fuld stood alone, pressed against the window, staring at the streets below, streets now filling with cameras, reporters, and tension sharp enough to cut through concrete. In a few hours, Lehman Brothers, 158 years old, survivor of the Civil War, 2 world wars, the Great Depression, would collapse. Not stumble? Collapse. It would be the largest bankruptcy in American history. $639 billion in assets, $619 billion in debt. 25,000 people losing their jobs in a single stroke. And the financial system, global, interconnected, fragile, would begin to crack. But here's the truth almost no one understood in real time. Lehman didn't fall because of bad luck. It fell because of a system engineered to hide risk, amplify greed, reward recklessness, and transfer every consequence downward. And when Lehman fell, the system didn't shrink. It expanded. So what actually happened? How did a company that lasted longer than most countries evaporate in under 12 months? Who saw the catastrophe coming? Who ignored it? Who could have stopped it? And why, after rescuing Bear Stearns, did the US government let Lehman die? To answer that, we need to go back, not to 2008, but to the humble origins of a financial giant. The rise before the ruin, before its name became synonymous with collapse. Lehman Brothers was one of the most respected institutions on Wall Street. Founded in 1850 by 3 German immigrant brothers, Henry, Emmanuel, and Meyer Lehman, the firm began as cotton merchants in Montgomery, Alabama. After the Civil War, they moved to New York and transformed themselves into an investment bank that financed some of the most iconic companies in American history: Woolworths, Macy's, and later, rising tech stars of the 1990s. By the year 2000, Lehman was the 4th largest investment bank in America, operating in 40 countries, managing trillions, and projecting unstoppable confidence. But behind the glass towers and million-dollar bonuses, Lehman faced a problem. Traditional investment banking, IPOs, mergers, advising was profitable, but not spectacular. And on Wall Street, good is never good enough. Then the dot-com bubble burst. Revenues crashed. Growth stalled. Pressure mounted. Lehman needed a new engine. And they found it: real estate. The shift that changed everything. By 2000, Lehman dove aggressively into mortgages and mortgage-backed securities. They didn't just finance housing. They purchased mortgage lenders, packaged loans into securities, and traded them for huge profits. The gamble paid off at first. Net income, $3.3 billion in 2005, $4 billion in 2006. Dick Fuld became one of Wall Street's highest-paid executives, earning over $40 million a year. But the profits weren't coming from safe homeowners. They were coming from subprime borrowers, the riskiest corner of the housing market. To understand what destroyed Lehman, you must understand the bubble they helped inflate. The subprime machine after the dot-com crash. The Federal Reserve under Alan Greenspan slashed interest rates to 1%, the lowest in 45 years. Cheap borrowing juiced the housing market. Prices soared. People felt wealthier. Demand exploded. But banks ran into a problem. They ran out of qualified borrowers. So they moved down the ladder. Prime gives near prime gives subprime. They lent to people with poor credit. No income verification, no job stability, no assets. These became known as ninja loans. No income, no job, no assets. But why did banks lend money to people who obviously couldn't repay? Because they never planned to keep the loans. The mortgage machine worked like this. A lender gives a risky borrower a $300,000 mortgage. The lender immediately sells the mortgage to an investment bank like Lehman. Lehman, bundles thousands of such loans into a mortgage-backed security, MBS. Rating agencies slap their ratings on them. Global investors buy them as safe. Everyone makes money. No one keeps the risk. It was a conveyor belt of profit feeding on the illusion of safety. But behind the curtain, the loans were garbage. The financial alchemy that doomed Lehman didn't just deal in mortgage-backed securities. They went deeper. They created CDOs, collateralized debt obligations, by taking the riskiest slices of mortgage securities and repackaging them into new products. Magically, insanely, the top layers of these CDOs received AAA ratings. It was financial alchemy, turning trash into gold through complexity. By 2007, Lehman held $85 billion in mortgage-backed securities and CDOs, a mountain of bets that depended on one thing: housing prices could never fall. But in 2006, for the first time in modern history, they did, and the cracks began to spread. By 2006, the impossible had happened. U.S. home prices stopped rising. Subprime borrowers began defaulting. Adjustable rate mortgages reset, and foreclosures surged. Mortgage-backed securities started losing value fast. Wall Street ignored the warning signs. In early 2007, HSBC announced huge subprime losses. New Century Financial collapsed. Two Bear Stearns hedge funds imploded. Then BNP Paribas froze withdrawals because its mortgage assets were impossible to value. The market wasn't unstable, it was frozen. Lehman still reported record profits publicly, but inside the firm panic was spreading. Risk officers warned exposure was too high. They were ignored or pushed aside. Dick Fuld believed the crisis would pass. He was wrong. The Bear Stearns misreading. March 2008. Bear Stearns collapsed and was rescued through a government-backed deal. Fuld assumed the same safety net would protect Lehman, but the political climate had shifted. The Bear bailout was deeply unpopular, and Treasury Secretary Hank Paulson decided the next failing bank would not be saved. Unfortunately for Lehman, they were next in line. The final countdown. Lehman had 6 months to fix itself, raise capital, sell assets, reduce risk, find a buyer. Nothing worked. By September 2008, Lehman had $639 billion in assets, only $25 billion in equity, and a deadly 25-to-1 leverage ratio. After announcing a $3.9 billion quarterly loss, its stock crashed 45% in a day. Lehman needed a buyer. Bank of America looked, then backed out. Barclays was interested, but UK regulators refused approval without use guarantees. Paulson refused. By Saturday, September 13th, the last deal collapsed. Lehman had no savior. The collapse that shook the world. 1:45 a.m., September 15th, 2008, Lehman Brothers filed for bankruptcy. And the shockwave was immediate. Markets plunged. Banks stopped lending to each other. Money market funds broke the buck. Global credit froze. AIG, exposed through credit default swaps linked to Lehman, was hours from collapse. Ironically, the government saved AIG the next day with an $85 billion bailout. Lehman was the only one allowed to die. Within weeks, the damage spread everywhere. Millions of jobs lost, trillions in household wealth erased, global trade collapsing, and the Great Recession officially underway. The aftermath. Accountability that never came. Congress grilled Dick Fuld, who blamed everyone but himself. Despite earning nearly $480 million during Lehman's boom years, he faced no criminal charges, nor did any major Wall Street CEO. Banks paid fines, but the executives kept their wealth. Congress passed Dodd-Frank to tighten regulations, but financial giants spent the next decade weakening it. And the biggest twist? The banks that survived became even larger. J.P. Morgan absorbed Bear Stearns and Washington Mutual. Bank of America absorbed Merrill Lynch. Wells Fargo absorbed Wachovia. The the too-big-to-fail problem became bigger than ever. The real lesson of Lehman Brothers. Lehman didn't fall because of chance. It fell because of a system built on leverage, hidden risk, and moral hazard, a system that only changed cosmetically after 2008. The same vulnerabilities still exist today. Overvalued real estate, rising leverage, massive corporate debt, regulatory rollbacks, commercial real estate pressures. The next crisis is not theoretical, it's already forming. Lehman Brothers wasn't an ending. It was a preview of what happens when a fragile financial system meets reality. And the question isn't whether another crisis is coming. It's which institution will be the next Lehman and who will be allowed to fail.